Hey friends, today's video is about high yield dividend stocks and passive income strategies. I am talking about 8% yield or higher. No, I'm not talking about 3% yielders today. I'm talking about 8% or higher, true high yield. And as you can see on the screen in front of you right now, I am certainly familiar with high yield. One of the stocks I own that's a higher yielder is ALTRIA, ticker MO. The starting dividend yield is an 8.21%, and that's a great dividend yield because it's a qualified dividend here in the United States, which means it's taxed as long-term capital gains. But my first purchase was back in 2009, and when I started buying this company, it was at $15.99. And so personally speaking, my simple yield on cost, which takes the $3.76 of dividends per year that I receive from this stock, and I divide by the cost of my first tranche, my first purchase of $15.99, my personal simple yield on cost, not even counting reinvested dividends, is 23.5%. That is the magic, actually, of long-term dividend investing. It is that compounding effect, and that 23.5%, it does not even factor into accord dividend reinvestment. But I'm bringing this up to set the stage that this is a video about high yielders, and when I buy a stock like Altria, or really any stock for that matter, personally speaking, I look at the money that I've invested is kind of gone forever because I never really plan to sell. And so the capital that I invest, I'm not really going to use that capital later. The reason I invest that capital is to generate passive income that I can use to pay my bills. And the reason I am illustrating this is the way that I approach dividend stock investing is very, very, very similar to Steven Bavaria's strategy in this amazing, amazing Income Factory book. And so this is a book that was suggested to me by my friend Greg. I interviewed him now 3 times on this channel. I will link to those interviews in the pinned comment below. Greg lives off of passive income, and he inspired me to read this book. And so I want to share my book review in the video today. I have a thorough book review of what I learned from Steven Bavaria and what I interpreted from this book. His strategies are different than mine, but at a philosophical level, I think we look at the overall investing landscape the same, is that money invested in investments is there to drive passive income that can be used to either reinvest or pay bills. Get ready, everyone. I have a really exciting video in store for all of you today. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So this is a very timely video, actually. I have spent some time today preparing this video. I'm filming it. I'm going to be up late tonight, editing it and publishing it. And the reason being over on Corner Patreon. I will link to that as well as in the pinned comment below. On Corner Patreon tomorrow morning at 8 a.m. Mountain Time. I live in Idaho, so I'm on Mountain Time. I'm going to be hosting a Zoom meeting, and that Zoom meeting is going to be the first ever virtual book club where my Corner patrons and we will be discussing this book and what we all learned from this book and sharing with each other in real time on Zoom as a community our thoughts around this Income Factory book. And so I thought this would be a really timely video to share my thoughts ahead of time with everyone out there on YouTube about the income investor. So I want to strategize and kind of strategically architect the video today into 3 segments. I want to first share some bond funds that I actually bought recently that are my first attempt at kind of an Income Factory type of approach, if you will, from my personal risk tolerance level. Then I want to get into how Steven Bavaria looks at generating income, how I interpreted his book. And third, I want to share my big takeaways from the book and how they apply to me as an investor. So let's get started. As you can see on the screen in front of you right now, my corner patrons already know this actually because I share my bond portfolio and my bond trades over on Patreon. On Corner Patreon, but I want to set the stage here. So I recently, after interviewing Greg and also after reading this book, and quite frankly, just given that bond prices have plummeted and have created an historic kind of buying opportunity, in my humble opinion, I recently bought some bond ETFs, and there are 3 of them I bought here. In addition to these ETFs, before this, I have been buying bonds for a while, and I've been buying basically the U.S. Treasury bonds. But these are more recent purchases, and the 3 funds that I bought were VCLT, which is the Vanguard Long-Term Corporate Bond Index Fund. It invests in investment-grade bonds. The 30-day SEC yield on this, which gives an illustration to the investor about what kind of forward passive income yield they might get on the fund, buying it at today's price, is 5.37%. Now, keep in mind that this 5.37% is not comparable to a 5.37% from a qualified dividend, because this is ordinary income. This is taxed at a higher rate. So I bought VCLT, and you can see on the stock chart, it has plummeted. It has plummeted because as interest rates go up, bond prices go down. And so because this is an ETF, a collection of corporate bonds, the value, the price of the ETF went down, and I took that opportunity to open a position. I intend to use the interest from these 3 ETFs. In addition to my treasuries, I already received my first tranche of interest from my treasury bond purchases to pay bills now. I'm not really reinvesting the interest from these. I'm actually using them to pay bills. That's a little bit in contrast with my dividend strategy, because a lot of my dividends, most of my dividends, I continue to reinvest these days to build the portfolio bigger. But the way I'm looking at bonds these days is literally paying bills with the passive income right now. And it allows me to delay tapping into passive income, quite frankly, from my core dividend stocks. Anyway, I also bought MUB. This is the iShares National Municipal Bond ETF. And this one is a 30-day SEC yield of 3.14%, but the tax equivalent SEC yield is actually 5.55. And the reason for this is these are tax advantage municipal bonds. And so the tax consequences on municipal bonds are very favorable, especially for those who are in higher tax brackets. And so I don't want to get into too much detail on these funds today. Perhaps in another video, and certainly over on Corner Patreon, I already did a very extensive blog post on it. The third one that I bought was SCHO. This is the Schwab short-term U.S. Treasury ETF. I already have a bunch of treasuries, but this one specialized, and I bought the treasuries directly from the U.S. government. I own them through maturity. This is an ETF, so a compilation of treasuries. And the reason I got into this one is it specializes in the shorter term treasuries, which I don't really want to buy one by one. And I love that the 30-day SEC yield is a 4.33%. What's so much interesting with this thing is it was flat. It was doing fine over long periods of time, but then it fell off of a cliff. And that just goes to show the environment that we're in right now. We are in a bond environment right now that is unlike what we've ever seen before. And quite frankly, I have a little quote on the bottom of the screen there. I've never seen that happen before. And so I want to kind of first just summarize what I just said, but then talk about this quote. I've never seen this happen before. So again, I was inspired by Greg. I've already been building a bond portfolio, and that has been all treasuries. Recently, I started stacking on top of those treasuries some ETFs that I just shared. And the reason that I'm doing that, and now one of the treasuries is one of the ETFs specializes in treasuries, but the reason I'm doing that is I see opportunity, and I was inspired by Greg in many ways. I was inspired by him also in my dividend portfolio to start skewing towards some higher yield yielders that offer value as well. And I'll link in the pinned comment to some videos I did on that recently as well. But I am using the bonds right now. Again, it doesn't compare in size to my dividend portfolio. I expect my bond portfolio over time, maybe it'll be about 25% of the size of my dividend portfolio, maybe 30% over long periods of time. But dividends are always my main focus. But I love the bonds here because I see a historical buying opportunity. And also, I feel fine using the interest right now to pay bills. Whereas with dividends, I have a hard time doing that. I'm using some of my dividends to pay bills, but I'd rather let them reinvest and compound than tap into too many of my dividend stocks right now. But again, that's the summary. What I want to share with this quote, though, I've never seen this happen before. It's so funny. I kind of feel like if I were just kind of 5 or say 10 years older than I am, a lot of life would have been easier in some ways from a business perspective. Because it's funny, when I'm in business and I just look at people that are not necessarily too much different than I am, but they're just kind of right place, right time. There was a lot of things going really well about 5 or 10 years ago. And I saw this when I worked in technology. A lot of these people who became big-time executives at a lot of the companies I worked at, they got their start working at Netscape back in the day. Unfortunately, when Netscape was a thing, I was still in high school, so I was a little too young to be working or being an executive at Netscape. But I see it in real estate as well. A lot of my colleagues who developed commercial real estate the way that I do right now, but they did it, say, 5, 10 years before I got started, it was a lot easier. And the commentary I've had throughout my business career, whether it was in technology or real estate, is I've run into some roadblocks or challenges along the way. And I always get this comment, Ian, that's kind of funny. I've never seen something like that before. It's really odd. And it's funny. It's this, I've never seen that before, but I hear that so much of the time. And so it's kind of funny because I feel like in my life, in my professional life, oftentimes I run into roadblocks that are just difficult, and they're things that perhaps in the past people didn't even have to deal with. But anyway, the reason I bring that up in the context of these bonds here is I think what we're seeing in bonds right now, especially looking at recent history, a kind of event where it's like, hey, I've never seen that before. It's like we've never really seen these in recent years, these shorter term treasuries offering a 4+% 30-day SEC yield. That is unheard of. We've never seen corporate bonds, like I showed with the VCLT, fall off a cliff, so to speak. Now, on the prior screen, the reason I actually selected those ETFs, other than the Schwab one, which is down a little bit, is over very long periods of time, all of them are, at least generally speaking, holding their value. This is going to be very important for you to earmark that comment as I go through Steven Bavaria's book, because for me, it's a deal breaker if an underlying asset that I own loses value over time. It at least has to hold some of its value, and that's one of the reasons I sold XYLD. I'll link to some of those XYLD videos in the pinned comment below as well. I have a lot of ground to cover today. Quite frankly, though, after reading Bavaria's book and after kind of thinking on it a bit and brainstorming on it, I'm not so sure selling XYLD, I even made the right call on that. And so that's fun food for thought as well. Again, I have a lot to go through, but I think we're facing a situation right now where it's a I've never seen that before kind of event. Hence, I'm very interested in bonds right now because I don't know how long these types of opportunities will last. And I'm very interested in the types of investments that Greg owns and that Steven Bavaria owns, because it may be one of those very interesting opportunities. And again, I don't know how long it's going to be around, but then again, I will never abandon my core dividend strategy, and I will never abandon going forward my risk tolerance. And you can already see on the 3 ETFs I just shared where my risk tolerance is at. It's very low. And so without further ado, now that I've set the stage, I hope you enjoy that. I'm up really late tonight. Please do click that like button. That means the world to me, everyone. It truly does. I'm so appreciative of all of the support here. I want to get into my book review, and so let's do it. Check it out on the screen in front of you right now. This is the first slide in my book review, and I want to first interpret Bavaria's approach. Now, I want to add the disclaimer that this is my interpretation. I don't know if I'm getting it perfectly right. I've never met Steven Bavaria. I know a lot of people that follow him take this very seriously. So the last thing I want to do is offend anyone. And that's why I started the ALTRIA example, that I get it. I'm a high yield investor in some ways, not all the time, because I'm all about my core 4 now as well. But and I have a very lower risk tolerance than a lot of people, but I want to do the approach justice. And I'm going to have some constructive critiques here, but I want to make sure everyone listening in, watching in, especially Steven Bavaria, if you're watching, that you realize I very much respect this strategy, and I think it's an awesome strategy. And any critiques that come are just as kind of, from my vantage point, learning about what you do. Anyway, what's the goal of Steven Bavaria? He is really striving to get an equity-like return with a fixed income investments. What are some examples of these fixed income investments? He likes to invest in high yield investments, leveraged loans, high yield bonds, preferred stocks, convertible securities, closed-end funds, such as in the utility industry or even in the real estate industry. He likes these specialized vehicles. I don't really understand them as well, but I'm starting to learn about them from his book called CLOs or ETNs as well. And he likes closed-end funds as well. Closed-end funds that invest in debt instruments, but also those that hold equities. And a lot of those closed-end funds, they can trade at a discount to the net asset value, and they might even use options to generate higher returns. And so he is using these types of higher yielding investments. And in general, probably I would say his thesis skews more towards fixed income to generate an equity-like return. And one of the reasons that he does that in a nutshell is traditional equity investors, especially equity investors who invest the way that the talking heads on TV kind of illustrate, like to buy low, sell high. They are investing in technology companies. They're on the roller coaster of the stock market. And it's very difficult for them. And Steven Bavaria even found, I think, in his own experience that it was difficult for him to invest that way, because that type of investing can work very well over long periods of time. But during deep market recessions and market corrections, it's difficult to hold on. And so he was looking for a strategy that aligned more with his ability to keep doing what he's doing over the long run, to see the passive income rolling in, and to have instruments that have less volatility to them so that he can generate those equity-like returns, but do it with less stress along the way. And this is why I started the video today talking about my strategy of buying dividend stocks just for the dividend, and assuming that the equity I kind of bought is, and the money I put in, it's just sunk, it's in there forever, I'm never going to see it again. Of course, I love to at least maintain what I put in, if not grow it over time. But my dividend strategy, very much, my philosophy is very similar to Steven's. Let's keep going. As you can see on the screen right now, the second thing that I interpreted from his approach is what I just said. He's in it basically for the cash flow. I think he generally assumes that money in the vehicle, he doesn't worry about it so much. I guess it's not really gone, but I don't think he really plans to sell. He's building a machine, an income factory, if you will, where the dividends can keep compounding, and it's empowering for him to see the cash flow coming in month after month. And very much he's investing for the dividends and the passive income, not so much worrying about the underlying ETF or the underlying closed-end fund going up in value, but that's always a nice bonus if it does. And he mentions it is nice to see it go up over time, the underlying value, if it does. Now, he basically believes that an income-focused strategy makes it easier to weather a down market. This is so true. In a down market right now, I can't even imagine being a Tesla investor, because a stock like that, it's down just so much. It's very volatile. And there's some investors that do really well with that type of strategy, but that's not really for my level of risk tolerance. I love that my core 4 stocks, Starbucks, Johnson & Johnson, PepsiCo, McDonald's, those are my core 4 favorite dividend stocks. They're not really down. They're hovering around kind of all-time highs, if you will. And so I guess one thing I would say, it's kind of hard to compare my strategy or to relate to what Steven's saying in the books, Mr. Bavaria, about kind of his strategy versus kind of volatile equity investing, because my equity investing, quite frankly, it isn't so volatile, at least this market cycle where everything's been so volatile. My core dividend stocks, my dividend stocks, they've been weathering the storm extremely well. And I think that's how closely my strategy, quite frankly, is aligned with what he's doing. I just go about it differently. I'm buying a stock like McDonald's that yields in the 2% range, and I'm holding for a very long amount of time to develop yield on cost, but I'm not really buying it for the capital appreciation. I'm buying it for the cash flow, but the capital appreciation, it sure is nice to see over time. But again, I'm going in a lot of different directions here because there's a lot of ground to cover, and this is really in-depth stuff. So hopefully, it's possible to follow all of this. I really appreciate everyone. The reason I'm talking about all this, though, is what Steven Bavaria says in his book is really, though, traditional investors who are kind of more, I'd say, tech stock investors or index fund investors, it can be a wild roller coaster in these stock markets. It really can be. And he's saying his income factory focused approach, it's so much easier to weather a down market. And that's why he got into it. That's part of his thesis. As you can see on the screen in front of you right now, the next thing I want to share is he believes that high yield investments get a bad reputation. And he says jargon like calling them non-investment grade or junk makes it even harder. Quite frankly, I started the video today. Talking about three of the bond funds I bought. One of them was VCLT. And one of the reasons I went with VCLT was it's a investment grade bonds. I wanted to go with investment grade because, quite frankly, to Mr. Bavaria's point, I'm terrified of non-investment grade. Just the word non-investment grade, that sounds really bad. And so I'm taking a lower return for it, but I'm doing it within my level of risk tolerance. But he says we view the unfamiliar as scarier and riskier. And he argues in his book that, quite frankly, these higher yielders, his income factory approach, which is buying high yielders where he doesn't really even look for capital appreciation. He's looking for all of his return or most of his return through cash flow, through distributions. He doesn't really think that that's a riskier strategy than equity investing at large. And quite frankly, he believes that it may have less risk. And he says that because there's these levels of risk. There's risk-free investments like Treasuries. There's interest rate risk investments like corporate bonds, especially longer duration ones like I own, because as interest rates move, those underlying corporate bonds, their value goes way up or way down, and you only get all your money back if you hold till maturity. In the interim, if I own a corporate bond and interest rates go way up, the price of that bond, the value of that bond on the traded markets is going to go down. But then he kind of gets into his investments like these closed-end funds. These closed-end funds honestly have less interest rate risk, he says, because a lot of the debt is shorter in duration, but it has credit risk because these are not investment grade loans. They're to basically everyone who's not investment grade, which he estimates, I think, is about half the companies out there. But then he says above and beyond credit risk, there's equity risk, and anyone that owns equity, any kind of stock, like Starbucks, for example, there's risk above and beyond the creditors, because typically if a company were to go bankrupt, for example, the equity holders are much low on the totem pole than the credit holders, the bond holders. Anyway, though, what was so funny about what he was saying about these layers of risk is he was saying, hey, equity investors, they don't even think about it this way, but equity investors not only have equity risk, but they have credit risk too, because any equity that I own, if they're taking out loans, they're taking out debt, they have credit risk, and by virtue of me being an equity holder, I have credit risk. And so he's saying credit holders, though, they don't even have equity risk because they don't have the equity and they're higher up in the food chain than the equity people. And so I thought that was an interesting way of looking at things, that he kind of says, hey, actually, these so-called junk bonds, they may be a lot or less risky than people think. And he was saying, in general, a lot of people, they'd be comfortable just owning the outright stock, but they'd never own the debt for that company, but they're getting it all mixed up because the debt has less risk than the equity. As you can see on the screen, though, my critique of Steven Bavaria that I would say on this particular topic is he talks about it more at a high level. But what I would say when I look at my kind of core 4 stock strategy, for example, I think my equity risk on my core 4, even though my equity risk includes credit risk, probably some interest rate risk too, I still think that the overall risk is lesser than a lower quality company's just credit risk only. So let's say, for example, I wanted to invest in Starbucks equity, or I wanted to buy some random smaller cap company, and it's not investment grade because by virtue of just being small cap, I just wanted to buy up their short-term debt. And maybe even I had a secured position on their short-term debt. I would argue you can't kind of generalize, because in that particular case, I would say there are cases where the equity risk is less than the credit risk when you're not comparing within the same company. But if you're looking at the same company, of course, Starbucks, if I had Starbucks equity versus Starbucks debt, the equity is riskier than the debt. So I just got to look at it that way. I think a picture is painted in the book and I think it's important to paint this picture because he challenges assumptions. And I think a lot of us do probably assume that junk bonds and higher yield has more risk than it does. But I also think there's a sub-segment of equity that is so premium, such as my core dividend stocks, that even though I'm taking on equity risk, the risk that I believe I'm taking on is lesser, quite frankly, probably than a lot of the closed-end funds that Steven Bavaria owns. That being said, to get the cash flow like Steven Bavaria gets, I have to wait many years for something like McDonald's to give me a yield on cost of 8% or more. And I've done a lot of videos on that topic before. Check out the history books, the archives. I've got some cool spreadsheets and videos I've done there before. But that was a nuance and a critique I wanted to point out. But let's keep going. As you can see on the screen in front of you right now, I want to keep going on my book review because I love this book. I really did. My wife, by the way, checked it out from the library for me so I could save the money. We're always looking for ways to save money, and I'm so thankful for my amazing wife for doing that and for finding ways to optimize our family's finances. And so anyways, the layers of risk that Bavaria talks about, generally, I think they only work when looking at the same company or same kind of class of companies. The fifth point of his approach is equity investors have credit risk too. I already covered that. I thought that was a really thoughtful point on his end. I want to keep going. I have another slide of how I interpreted the book. Then I'm going to get into what it means for my strategy and how it got me thinking. Every book I read, I want to understand what is the author saying, but then I want to understand how does it apply to me. And so let's keep going. As you can see in front of you right now, point number 6. Basically, an income factory strategy of high yield funds, he's saying it's not inherently riskier than the average investment portfolio. It may even be lower risk. And this is honestly what I just talked about, but it's fine to repeat it because it's a nuanced point. It's important to get this right. And I'm not sure even what I just said totally gets it right yet because this is kind of confusing to explain all this stuff. He does a great job in his book of doing it, though. I am not the average investor. The most average investors out there probably hold like mid-cap, small-cap stocks. Maybe they even hold mid-cap, small-cap ETFs. If that's your average investor, I totally agree that holding high yielders, which is basically debt positions on these same small and mid-cap equities, is not inherently riskier. In fact, it's probably less risky. Absolutely, I agree with that. My critique, though, again, as I just said, is I'm not so sure that the debt positions, the credit positions, even those that are secured on those small and mid-cap companies, are they inherently less risky than what I do with core dividend stocks? In my mind, at least, probably not. But put in the comments below what you think. I hope, Steven Bavaria, you're watching the video today. My friend Greg said you're active over there on Seeking Alpha, so I hope you check out this video. I'd love to hear your thoughts below. I think we are cut from the same cloth, so to speak. We just do our things a little bit differently. I think my risk tolerance is a little lower, and I'm just waiting a lot longer for the cash flow. But boy, I understand and I can relate to so much of what you say in your book. Let's keep going. As you can see on the screen in front of you right now, the next thing I want to go through is number 7. And so he points out one of the challenges with dividend growth investing, like I talk about here on my channel, is we need the company to grow. If the company does not grow, my whole concept of yield on cost, what I shared with you at the beginning of on ALTRIA, for example, where I'm at 23.5 yield on cost, simple yield on cost on my first tranche, it just doesn't work. And so dividend investors in some ways are taking on a lot of risk when they are doing it purely for cash flow like I am, because we need these companies to grow over time. But he says, in contrast, income factory investors need the companies just to survive. Just survive another day to pay their debt obligations. Stay in business. I love that point. Greg brought that up in his interview too. I love that point. And that's a great critique of him against dividend investing, because it's true. Nothing I talk about here on my channel, on my core dividend stocks, on any of the 51 stocks I own in my dividend portfolio, generally speaking, it doesn't work unless the companies over very long periods of time grow their businesses so they can pay higher and higher dividends. Although some of my higher yielders that are very similar to income factory style investments, of course, they don't need to grow as much. Point number 8, dividend growth investors rely on dividend increases. But dividend increases are not a given. How many times have we been disappointed? I thought this was really thoughtful as well. His strategy is all about locking in yield now, getting 8% or even more right now, reinvesting the distributions and letting the factory do its thing. And any kind of growth of the underlying security is icing on the cake, but he's not really looking for it. And he's not counting on dividend distribution increases, but they may happen over time. By contrast, he points out, people like me, we need those dividend increases. And how many times have we been disappointed? Even if the company does really well, Pfizer's a good example. They could increase the dividend a lot more than they have, but I know they're not because of political pressure, because I think there would be a lot of backlash on them, so they're smart not to. That's the world of dividend investing. So I guess to his point, dividend investors like myself, we are taking that leap of faith. We are taking on some risk because he gets his yield from day one. I have to wait for my yield, and that yield I'm waiting for is not a given unless the company thrives, and not only thrives, but the company decides to increase the dividend. Let's keep going. As you can see on the screen in front of you, the next one I want to go through is point number 9. His approach that resonated with me, which talked about debt, credit, is largely retirement account focused. I'm not doing it in a retirement account. Quite frankly, I'm doing all my bonds right now. Not all, but a lot. Actually, I shouldn't say all, but the majority of my bond activity right now is non-retirement account focused. And basically, he's saying, though, this approach works. His approach, the thesis, it works best in retirement accounts because of the tax advantages. We all know in individual accounts, his strategy with ordinary income can have heavy tax implications. That being said, in his book, per point 10, as you can see here, he talks about a few different types of distributions. He talks about qualified dividends, which is my bread and butter, what I do all day, every day with my core dividend stocks, which works for me because I largely have a non-tax advantaged structure. But he also talks about ordinary income and return of capital. Now, the distributions from a lot of the credit positions, the bond positions, it's ordinary income. I'm just dealing with it on those ETFs I shared earlier in the video today. But what he does propose in his thesis is that there's different types of income factories. One, there's an income factory light, which is a hybrid between what I do, which is core dividend stocks, and income factory style investments, which would be the types of funds he discusses. That's kind of what I'm constructing in my own way right now with my treasuries, with my bond ETFs, and kind of marrying them with my overarching dividend strategy. He talks about that as a way to mitigate taxes. But another thing he talks about is there are income factory strategies that involve equities. And so he talks in his book about closed-end funds that deal with equities. They do options on equities. They trade equities. They generate a return. And some of the distributions that come out of those are considered return of capital, which is actually tax beneficial as compared to ordinary income. So there are, even though the lion's share of what resonated with me in this book from Mr. Bavaria is largely heavy on the tax front, there are ways to do an income factory approach for someone who's really mindful of minimizing taxes. That said, it's a little different. And that part of it, other than the hybrid approach between dividend stocks and income factory investments, it didn't resonate with me as well because I started looking down that path of closed-end funds that trade stocks and use options and even sell off portions of stocks to pay distributions, and they do that through return of capital. That didn't resonate with me as much because at my core, I'm a buy and hold forever investor. And I don't really like using options quite as much unless options are used leverage is used very cautiously, and I feel more careful and just better for my level of risk tolerance if leverage ever is used, if it were done in the real estate arena on very solid assets at a very low leverage rate, or if it were done on a fixed income. And so I feel more comfortable with leverage over there. But on equities, I get a little more, just for my risk tolerance, it doesn't resonate with me. Anyway, though, I wanted to provide that nuance because he does cover it in the book. Let's keep going. As you can see on the screen right now, the next point I took away, he has an emphasis on selecting the right fund managers. His strategy is a fund of funds, if you will, and so he has to pick the best managers out there. Last, he says that income factor is an attitude, and you may already have an income factor. And this is where he was really like, I was like, hey, man, you're my brother. You know, it's like, I get it, Steven Bavaria, because, yeah, it's an attitude. I look at my portfolio as an income factor, even though I'm not doing exactly what he's doing. When I buy a dividend stock, the money I place into it, I don't want to see it go down over time because that's just philosophical for me. I want to buy something that's going flat or up over time. But I look at that money as being retired, and I'm only looking towards passive income. So it's an attitude. And I think a lot of us here on PPCE, and over 80,000 of us, thank you everyone for subscribing. It means the world to me. Boy, I was looking at the video views, over 7.5 million video views. Can you believe it? Boy, thank you everyone again for watching these videos. I put so much effort here, but I know all of you spend your valuable time watching these videos. It means the world to me. I know a lot of us, put in the comments below if it's kind of, you're in that income factory attitude as well. I'd love to know. I certainly am. So what I want to do now is I want to go into the next segment of the video. And I want to talk about, okay, this is, I just described what I interpreted his strategy to be. Certainly read the book. You might have a different interpretation, but that's what I interpret it to be. Now, what does that mean to me in my world? Because I'm not just the type of investor that's going to be like, okay, I'm going to do what he did. I know a lot of people, they do that and it works for them, but I've always been one to kind of carve my own path, if you will. Some of that has been at my detriment. I've made a lot of mistakes investing, and I've had to learn a lot of things the hard way, but I like to carve my own path. So I'm trying to think now, what does all of this mean for me? Let's look. As you can see on the screen in front of you right now, I have a few slides here as well. So my takeaways for my personal situation is, one, I have a contingency plan that I never knew I had. Let's say, this would be terrible, but my active income, it just dried up. And let's say I wasn't in a position really to get another job, to drive more active income. Done. It was really refreshing just to take stock of our family's finances right now and look at them and say, hey, if I sold everything and I transitioned it all over into income factory investments that I was comfortable with that were yielding 8 to 10% or more, that would probably be just fine. We would be fine to live off of that income. And I would, maybe I'd have to have some side hustles here or there. Maybe I'd keep doing my thing on YouTube. I hope I'm doing this into my 80s or 90s or 100s. But we would be good. We would be okay. And that was really refreshing to see. And so it kind of gave me like a perspective that I have a contingency plan I never knew I had. Am I comfortable just doing that right now? Probably not. It's not really my plan. But if push came to shove and, we needed cash flow now, I could do that and we'd be in a good position, or at least an okay position. And so I was really thankful. That was the biggest takeaway. One of my biggest takeaways from the book. I loved it. Let's keep going. As you can see on the screen right now, the next takeaway I had for my personal situation is I had a little bit of a concern. We were in a low interest rate environment for a long time. Rates are rising right now. Quite frankly, some of the instruments that Steven Bavaria lists in the book, or a lot of them, they've decreased in value over time. And this was kind of a issue for me. There's a few of the assets that he owns that I'm taking a hard look at. Quite frankly, I'm going to cover these in more detail over on Patreon, but the tickers are MCI, FPF, and CHY. Those are on my watch list. So if you're listening and watching closely, that was one of the nuggets from this video, is actually I went through all of his suggestions from his book, and I picked the 3 that I felt were the most stable and most in line with my level of risk tolerance over long periods of time that were yielding. And all of these are on the lower end of the yield spectrum. The first 2, I think, were in the 8% range. The last more 10%. But it's MCI, FPF, and CHY. Will I pick one of those and add one of them perhaps to my personal bond portfolio or my income factory in a small way? Maybe I will. I'm kind of eyeing that MCI. We shall see. It'll be fun. But my concern was kind of back to that quote at the beginning of the video. Hey, Ian, boy, I've never seen that before. I've heard that from everyone. I guess I've just seen so many things in life that others, they've never seen it before. But I kind of feel like, are we in one of those situations where the income factory worked for so long, but hey, I've never seen that before. Maybe it's not working anymore. I'm not saying I know. I'm just pointing out we're in a weird time where things are changing. Rates are going up. I know with the rates going up, the income factory funds are dropping. Perhaps it could be an amazing buying opportunity. Actually, I think it probably is. That's why I went ahead and I've been buying up bonds over the last year. And I'll probably consider adding to one of the tickers I just mentioned or another one. That being said, if the Fed keeps raising rates in perpetuity, there's going to be a problem. My calculated bet is the Fed is probably going to have to pivot. And when they do, this snapshot in time right now is a pretty darn reasonable time for someone that doesn't have a lot of exposure to bonds, to credit, to fixed income, to gain such exposure. And that's how I'm looking at it from my perspective. But I could be completely wrong. If the Fed just keeps raising rates in perpetuity, I'm entering these types of investments way too soon. And the underlying value of a lot of these income factory style investments, it's going to probably keep eroding if that's the environment we're in. That's a concern of mine, and that was a big takeaway or perspective I took. But again, my perspective is that the Fed probably will pivot sometime in 2023. We shall see. As you can see on the screen in front of you right now, my third takeaway was equity-focused income factory is more tax efficient. I'm talking about the closed-end funds that are doing a lot of return of capital, and they're using leverage, they're trading, they're returning a portion of the profits from the trading to the equity, to the holders, the unit holders of the closed-end fund. I already mentioned this, but you know, that's great and all, and it would probably be more tax efficient for me, but I like the debt-focused income factory more. Even though it's less tax efficient for me, it just better aligns with what I'm trying to do in my portfolio. One thing that he talked about in great length in his book was this concept of senior loans. I thought these were really cool. These are loans that are made to non-investment grade companies, which is basically, I think he was saying like half of the companies out there, but he was saying they're senior in relation to any other debt that the company has. These can yield 5% on average, but with a little bit of leverage in the closed-end funds, those funds can yield about 8%. That being said, I was like all about these senior loans when I was reading the book. And I'm like, you know what? I'm going to find a closed-end fund with senior loans that I want to buy. Okay. I looked at every single CEF, closed-end fund, with the senior loans that he illustrated in his book. All of them are eroding in value over time. I'm okay with something flat. And I'm okay with something that just trended down just starting recently because we're in unparalleled times. But I'm not okay with something that's just trended down over long periods of time. And so that's why right now, senior loans, I don't really have a contender, but put in the comments if you've got one. I thought what was fun, though, is he was talking about the senior loans, he said there's two types of credit risk. There's risk of just defaulting, but there's also risk once something defaults, they can't pay back the loan. How much is lost? Maybe they pay back part of it. And he was saying with the senior loans, typically, you can recover about 75% of all outstanding principal, which is great, even in a default case, where he said unsecured debt, the non-senior loans, you're only going to recover on average about 50%. So I thought that was a fabulous statistic. But what I took away is I'm on the hunt for like senior loans. I want to learn all about this. I want to do senior loans, but I have to find something that does senior loans without losing underlying value over long periods of time. So put in the comments below if you have one of those. So far, I haven't found that. And so that was a critique of mine of the book. When I looked at a lot of the investments that Steven Bavaria has made, they offer these huge yields. But over long periods of time, I have seen the underlying equity on them drop. But again, could it be the buying opportunity of a lifetime? Perhaps it is. We're in unparalleled times, and with the rates finally going up for the first time in over a decade, for a very long time, to this magnitude, it is obviously changing the pricing of a lot of these structures. And again, that was my thesis behind buying Treasuries, for example. So I am in some ways in the same camp as Steven Bavaria. I just do it with a lot less risk because I'm going for Treasuries, but also with less risk comes less cash flow, but I'm willing to live with it given my level of risk tolerance. I got to be true to myself. Let's keep going. As you can see on the screen in front of you right now, the next thing is, and my final slide today actually, is I don't need to belabor the point, but a lot of the funds that he shared, like these CLOs that he seemed to highlight in the book and he is very much a fan of, they've trended down over time in share price. He was saying that the income factor is for those that don't like plunges in values of assets during market reversals. But quite frankly, I'm seeing these assets, not all of them, but a lot of them go down over time. And they've gone down a lot more than the core four, and not only my core four, but all my dividend stocks on average, which have weathered the storm really well. And so I would say maybe a lot of these funds is better from a risk standpoint than just owning really risky, non-profitable tech stocks. But as compared to core dividend stocks, I would say perhaps there's some more risk there. That being said, the yields on these stocks or on these closed-end funds and these other opportunities that Steven Bavaria highlights are so amazing that perhaps it just compensates for whatever underlying equity is lost. That's part of it as well. And I'd love to know in the comments below if some investors look at it that way, that they don't care the underlying equity is eroding because the cash flow is so enormous that it just makes up for it. My vantage point and my biggest takeaway is the trick for me is I'm open to this stuff, but I have to perform incredible research to find the types of income factor investments that can hold their own in share price over time. That's just where my risk tolerance is at. That's why I started all the way in the beginning of this video with those 3 ETFs. I know they're really low risk, low yield. Maybe Steven Bavaria wouldn't even consider them quite income factory material, but maybe he'd say income factory light. That's why I picked those 3, to be honest, is because I can't stomach the underlying equity value eroding over time. Point number 6, I like forever. One of the things that's hard for me with high yield and with fixed income in general is typically shorter duration. Steven Bavaria was saying that a lot of these investments he makes, the types of credit that they invest in is real short term. I do some longer term stuff like my 20 and 30-year treasuries, but that's still not forever. I'm just talking really about my personal vantage point here, but I'm a forever type of investor. And so I guess it's forever if you buy these closed-end funds and you believe in the management forever. But there's nothing like buying a dividend stock and just kind of locking in a starting price forever. But that's why, quite frankly, in my fixed income investing, you've probably seen me now skew towards longer term investments. And quite frankly, with the corporate bond fund I brought, they're longer duration corporate bonds. I would say point number 7, are we headed into a new era? Are the old rules gone? Is everything just changing? Is this back to that quote at the beginning of the whole video? Ian, I've never seen that before. Boy, that's crazy. Everything's falling apart. I would have never seen that before in all of my 30 years of investing. That's what I'm hypothetically speaking from the shoes of someone a little older than me. Or is this a tremendous buying opportunity with the Fed pivoting? In general, I kind of skew towards the latter, tremendous buying opportunity. But again, I have a risk tolerance that's a little bit different out there. There's only a very select subset of debt in general that I'm willing to go after for myself, and that's okay. The last takeaway that was so fun was I did some videos on XYLD and I sold it. I sold it because it was going down in underlying equity value. But honestly, the thing is stabilized a bit, and if you look at it over really long periods of time, it's honestly holding its own, and it's honestly holding its own better than a lot of the funds that Steven Bavaria shared in his book. And so I wonder, did I jump ahead on that XYLD a little bit? Should have I kept it? Fun food for thought. I'm okay either way. I'm probably not going to buy it back. The reason, quite frankly, is when I look at my portfolio as an overarching strategy, I want it to be very focused on dividend stocks. I want to have some exposure to fixed income. XYLD, it was doing covered calls on equities. I don't really need that in my portfolio. I'm more comfortable owning debt. I'm more comfortable owning equities. And also I own real estate as well. And so that is the portfolio that makes sense in my personal situation. But I'd love to know what you think about my book review, what you think in the comments below. Again, I am not trying to say the income factory strategy is right, wrong, anything other. I'm just trying to take what it means for me in general. I love the book. It was a great book, and I look forward on Corner Patreon tomorrow to discussing it at 8 a.m. bright and early. I got to edit this video now. I'm going to be up late tonight. I love you all. If you enjoyed the video, please go ahead and click the like button. It means the world to me. And also, just so you know, Corner Patreon this year, that is somewhere I am investing an enormous amount of time. So if you haven't signed up yet, even if you've been there in the past, check it out. There's a lot of new stuff coming there and already is there. Before I go in terms of full disclosure, I am long the core four stocks, Starbucks, SBUX, Johnson & Johnson, J&J, PepsiCo, PEP, McDonald's, MCD. I am long Pfizer, PFE. Also, I am long Treasury bonds. I am long a few other bonds as well that I mentioned today. I'm long Vanguard, long-term corporate bond index fund, VCLT. I'm long iShares National Muni Bond ETF, MUB, and I'm long the Schwab short-term U.S. Treasury ETF, SCHO. Also, I've got a few on my watch list that I may buy, MCI, FPF, and CHY. And so also, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, bond market, credit market, anywhere, please consult your licensed investment advisor first. It's possible to lose money with investments. I'm just sharing my journey here on YouTube for fun and entertainment. I love you all. I'll see you in the comments below. And I will see you in the next dividend stock investing video.